let's go back to the powerful business model, right, where it all comes together. The product pieces, that very differentiated go-to-market, and how it all wraps up into numbers, which is, I know, ultimately what you all care about. Can Square be a great company? Can we build a great financial model? Can we therefore be a great stock over time? So how does that model come together? Tremendous scale, significant growth at scale, very attractive cohort economics, and a strong margin trajectory from here, and hence a stream of future cash flows that you can all value into what we believe is a great investment. So you've seen the significant scale and the growth at scale. Just to remind one more time, since our IPO, we've seen 43% growth in GPV, which is one strong indicator, but just one piece of our business model. And then adjusted revenue, where you see all of our business model come together, 73% growth since our IPO. So I'm going to dig into a couple of key questions that you've asked us along the way. And since we have a little bit more time this morning, I'm going to dive into where the growth comes from. So talking a little bit about just the efficiency of the onboarding channel, payback period, and so forth. I'm then going to talk about this great big engine that sits under our business model, the revenue retention piece. So the fact that the base itself actually grows year after year. And then finally, I'm going to dig into the margin profile and how we think about longer term financial models, but also how we're thinking about investment. So let's start, first of all, talking about the efficiency of the onboarding channel. So I'm going to take you back to a cohort in Q1 of 2015. What we mean by a cohort is all of the sellers who joined the Square platform in that 90-day period, Q1 2015. In order to go get that cohort, we clearly spent money. Now, some of them came organically, as Kevin pointed out, through word of mouth and referral, but many of them came because we put money into Google Paid Search, because we did a direct marketing campaign. I don't know if we had DRTV turned on at this point in time, but clearly we paid to bring sellers on the platform too. And this is really a fulsome view of the spend. It would include if a salesperson talked to them, that salesperson's salary, if an account specialist talked to them. So we are very complete in terms of the cost to bring that cohort onto the platform. From there, the cohort joins and they do that first thing, the critical thing, they take payments. And when they take payments, that creates revenue for Square and ultimately creates transaction-based profit for Square. And so you'll hear us talk a lot about our payback period. This is what we mean by it, and this is on payments only. So in that first quarter, it builds, and then over the next 4 to 5 quarters, cumulatively, we reach a point of payback. So effectively, the $36 million that we've given out to bring the sellers on the platform gets paid back to us. So by the end of 4 to 5 quarters, here on this particular cohort, they have paid back $40 million. So it's a pretty good investment in a fairly short period of time. But it gets better because clearly they don't just stop once they pay back. They keep on motoring. That's what we love about our sellers. They're constantly innovating and iterating themselves and hence growing. And so at the end of 8 quarters, so over a 2-year period, we've done $62 million in cumulative transaction-based profit. So what does that mean in terms of ROI? So if you just look at that same cohort, a 1.1x ROI after the first year, and then effectively after 2 years, almost a 2x ROI, 1.7x ROI after 8 quarters. So that was one cohort, the Q1 of 2015, using real, actual numbers. This is what happened. So now let's look at it holistically. And so I'm going to go to annual cohorts. So what you see here, starting with the smallest gray box, 2012, this is the cohort that was 2012 and before. And we're a young company, so it's really 2 to 3, it's 2010, 11, and 12, all rolled into one cohort. And the amazing thing is that even by 2016, this cohort is still growing on a dollar basis. So again, just so I'm super clear, there's a bunch of sellers that joined the platform. Some of them clearly went out of business. These are small businesses. So this is what you ask us all the time, what is your churn rate? And we say, we care about dollar-based churn because individual sellers are not really created very equal on the Square platform. Someone that gets a reader to sell their couch on Craigslist is not equal to even Sam coming on as a flower store, is not equal to Laser Away. So counting sellers will mislead you. What you need to count is the dollar-based GPV, transaction revenue, transaction profit. And since the ratios between those have been really stable over this period, I look to transaction-based profit because that's the input to adjusted revenue. And so even by the end of 2016, that cohort is still growing. Now what's magical in the model is this is true for every cohort. So if you look at 2013, 2014, 2015, 2016, we have not yet seen a cohort actually shrink on a year-over-year basis. So why? One, the value proposition, never miss a sale. So we know that when sellers don't accept cards, people walk into their store, walk up to them in the farmer's market. I'm the queen of this, I never have any money. And I want to buy your flowers, and you say, sorry, I don't take cards. And maybe if you're really helpful, you direct me to the ATM. But I never have time for that, so you miss my sale. So number one is you never miss a sale. The second reason is people come on often using us in one particular use case. And I think what we've gotten a lot better at over the course of our history is taking more and more of your book of business. So you might use us in your restaurant for your in-person, but now if you're doing catering, as Jesse mentioned, we can take your invoice. Or if you're Reynolds Trucks and people are calling in and you're writing it down on pieces of paper, God help you, that is a terrible PII infringement happening right there. You are now able to put it into the PC where maybe you're doing the rest of your business. So it's up to us to keep looking to where that book of business is and making sure holistically we're getting that full book of business. And the third reason is just the survivorship bias of small businesses. Sure, they start small. Every entrepreneur has the first sale that they make or the first customer they bring on board. But small businesses often start in that farmer's market, and very quickly they become multi-location, even multi-country. And we've seen that with some of our sellers, actually, to date, even at that scale. So that's number one. Every cohort has grown. The 107% that I'm showing you here is in Q1, because we look at this every quarter, and we talk about this on our call when we talk about positive dollar-based revenue retention. On the trailing 4 quarters for payments only, 107% is the number that we saw. But it doesn't just stop there, right? This is just transaction-based profits. There are other ways that we monetize our products. So let's look at a seller.
Most people know Square for the payment system, but there's so much more. Now we use Square Capital, Square Appointments, invoicing. You can connect it to QuickBooks. There's just so much there that makes life so much easier.
Tells it much better than I do, and they finally let me have a video as the finance person, so I was kind of excited. So let's think about Nathan, or this is Jake's illustrative example. It's not their actual numbers, because you can show actual seller numbers in front of you. But they may start just doing transaction processing with us, so the critical moment where we help them take a payment. But from there, they do a build-up. They might then start to use invoices. They may take a capital loan from us. Start to use appointments. People come in and want to get their pants hemmed. The customer engagement, right? You saw Samuel's presentation about how important that customer engagement piece is. And so that cross-sell and upsell opportunity starts to get quite big on our base. And I think we're only kind of scratching the surface of this, because as you ask me many, many times on calls, what is the attach rate? And I effectively say, we don't give out attach rates by product, and you'll probably ask me when we're all sitting on stage here later. And the reason we don't is because in most cases, it's still a really small number. Right? We're just beginning to make our customers aware of all that we do, and for them to grow up into the products that we're offering them. So what does this mean for the 2 metrics I was just talking about? The ROI, the cross-sell and upsell, so the payback period, and then ultimately the dollar-based retention rate. So let me take you back to that chart that I showed you, where Q1 of 2015 cohort, right, we spent $36 million to bring them onto the Square platform. And over an 8-quarter period, we returned $62 million in transaction-based revenue, transaction-based profit, adjusted revenue. Now, when you add on the incremental products that cohort has taken, and these are real numbers again, you see $79 million has been added into the total return to Square. So what does that mean for payback and revenue retention? Clearly, it means that the payback happens faster, and I think we now have more confidence. in what that payback and ROI is going to be, because we can see these products actually having multiple quarters and now multiple years of life. And from a revenue retention standpoint, you see that the revenue retention is starting to get even bigger, 113% on the trailing 4 quarters. So these are actual numbers of what our business did in Q1 of 2017, if you look back over the trailing 12 months. So what does that 113% really mean? So this is a number that, as an ex-analyst, I used to watch a lot for software as a service for SaaS-based companies, right? It was a really good sign of the health of their business. So forget about payments companies who usually actually start in the hole every year, right? They churn out customers, and hence just to get back to 100%, they actually have to add customers in the base. We actually start with growth in the base every year. And this is what it looks like on a relative basis. So you can actually go audit these numbers. The public company SaaS average in particular, and these slides will be up on the website so you can see all the companies that we included. But the average for a SaaS-based company that's doing cross-sell and upsell into their base is about 5%. And that's pretty darn awesome. Like, I used to be really wowed by that. When I put that in the context of Square's model, like, we have built an incredible machine, a base that is growing and adding, even if we never added a single new customer. Okay, so I'm going to transition now to margins, to the profitability part of the story. So even as we have shown that really significant growth at scale, we have also shown you margin improvement. And you can see that in how the adjusted EBITDA margin has grown over the course of the last 3 years. How have we done it? We've shown leverage in all of our expense lines. Product development, sales and marketing, the G&A line, the other, which is largely risk loss. I'm going to talk about that in a second. And it's not surprising, right? As you scale a company, you don't have to keep recreating the same things. There should be leverage as we scale. Let me talk about one area that we've actually seen really strong leverage or really strong performance. And it goes back to a lot of what we've talked about through the day, that we're utilizing technology to build a much better, more efficient company and business. So this shows our transaction losses over time. So if you look from 2012 through 2016, we've seen about an 8x growth in gross payment volume. Again, it's a good metric in my mind to think about the scaling of Square. In that same time frame, transaction losses have only grown 4x, which means we must be getting better at managing it. And that's what you see on the line on the far right of this chart. Where transaction loss as a percentage of GPV has fallen from 0.17% to 0.09%. Now, of course, any business can make itself increasingly secure because you just narrow the window and you ultimately just sell to your friends or something, which we don't want to do. In fact, we view this as an expense line that we often don't want to get too low on, because of the point that Jesse made, which is we want to be able to accept 90+% of all the sellers that come to Square. The beauty of what Kevin talked about, that virtuous cycle of hearing about Square, going to our website, being onboarded in minutes, and getting your first experience of Square is a huge part of what makes the machine work. And being able to manage risk this way is a huge part of what makes the machine work. It's that interview question I asked, like, why does a car have brakes? To make it go faster. In the same way, why do we have great? It's so that we can go faster. Okay, so then a final question that I feel that you all asked, or not a final question, second from final, which is about incremental margin. And some of you have written about this as well. So when you ask us about the long-term margin profile of this company and what can it be, and then the follow-up question is usually, how can you be sure of that? Or what's your confidence? Or what's driving that? But a huge part of that confidence comes from knowing what the incremental margin is from $1 of new revenue. Because with that incremental margin, you could do one of two things, right? You can invest it all back in for growth, and we're going to talk about that because we actually believe we have a lot of opportunity for growth. Or you could just say, okay, we're done, we're not going to invest anymore, we'll let it all spew out the bottom of the model, which we don't really want to have happen. But at least this gives you a level set on what the incremental margin looks like. So in order to calculate an incremental margin, I just want to be clear on what we view as fixed costs and then variable costs. So from a fixed cost perspective, there are investments that we've made already to grow, right? We are a company of almost 2,000 people. We have brought in a lot of engineers, designers, I was going to say material scientists, but that would be me, machine learning folks. We have hardware development. We have a wonderful hardware lab. We have a risk operations team, and all of the corporate operations you'd expect, the finance team, the council team, the communications team, et cetera. So those are largely fixed today, right? Those are the engine that have created all the products that you've seen to date. When we get new revenue in the door, there's clearly a variable cost component to associate it with it, right? Customer acquisition costs, but beyond that, there's ongoing variable. So cost of goods sold. For example, Caviar has a restaurant and a delivery cost associated with it. There's cost to just send bits and bytes through data centers, things that we pay out to AWS or the Google platform. There's support and compliance costs that come with each new dollar that gets added. But how does this really break down? So this to me is a money slide for you all to see and understand what we see on the back end for Square in terms of the incremental dollar, what's the margin you get from it. So I'm actually going to start with the subscription and services-based revenue line first, because I think it's more intuitive, and I think most of you have already got this, understand this, because this is what you see when you go talk to kind of classic software as a service type companies, right? So when you get to scale, the purple bit is the variable cost that's required to bring in the new dollar, but the dark gray bit is effectively the incremental margin. Again, that's your choice moment. What are you going to now invest back in for new growth versus what becomes just the profits of the company? But I think the pie chart that's probably more surprising is the transaction-based profit chart or transaction-based adjusted revenue. So when we bring in $1 of transaction-based adjusted revenue, it's actually remarkably similar. And I feel like one of the misconceptions of Square has been that somehow this is not similar at all, that there's no profit here and we make all our profit from over here. No. This is why we like both ways to monetize our products, because actually the incremental margin of both revenue streams is remarkably similar. Okay, so let me switch gears to, we now have this dark gray stuff. What are we going to do with it? So if you look at our investments to date, I've already talked about them, right? We've invested in great engineers. From a sales and marketing perspective, Kevin took you through a lot of the highly scalable channels that we've already built out. Things like Square Cash. We've not talked a lot about its business model today, but there are peer-to-peer costs in order to send Square Cash across those rails instantly from person to person. And clearly, we've built out now a public company scale of G&A functions. Where do we want to continue to invest? So every time you ask on our calls, this is where we're going. We want to keep building out a world-class team. We firmly believe we have a massive opportunity ahead of us. And it is going to require more engineers, more data scientists, more designers to make new products come to life. We want to keep investing in go-to-market. There's tons that we think it's done, and then there's tons of new stuff that we learn all the time. Like, who would think you could do this much innovation in direct mail that's been around for decades and decades and decades, and yet we had a wonderful presentation just last week at our stand down for the week where one amazing data scientist talked about how he'd spent the last 12 months of his life getting a 30% increase in efficiency out of direct mail, which just shows how much more there is to do. There are channels like Facebook that, frankly, I don't think we even did Facebook when I first joined the company. Like, it wasn't a channel. It didn't really exist. And so we're constantly iterating on that. And as we go into new countries, we find that things that might work in the US are not the same in another country. There's a different avenue to get out to your customer. And then from a G&A perspective, I want to make sure we're investing there as well. There's a ton that we can do to utilize technology to make those functions even more streamlined and efficient. Support is often the example that I'd like to talk about, because I think it's a place where we can actually create an amazing experience for our customers. So let's get in front of them. Before they even realize they have a problem, let's use all of the data points we're collecting with an ML model applied to effectively preempt the question coming in, right? We see you wandering around in your dashboard, looks like you're looking for a deposit. It's a long weekend. Let's remind you that the ACH system went to sleep, including Monday, and we'll be back up on Tuesday. You'll get your funds on Tuesday. But what a remarkable time to also offer you an instant deposit, because it's contextual. You'll need it. You're that small business. So that's where I think you can go even further with the internal efficiencies of the company to go far beyond just serving customers better, but now how do we really make them aware of new features and functionalities that will drive cross-sell and upsell. So finally, just in terms of the very long-term investment roadmap, I wanted to give you a little bit of an eye into how we think about planning from an annual perspective, and really it's over multiple years. So I think about it in terms of horizons for growth. So Horizon 1 is typically the areas that are much more proven. They've already got a strong ROI associated with it. They're probably driving most of that incremental margin today that you saw. We're certainly not done here. As proven by products like Virtual Terminal or Invoices or Instant Deposits that kind of come from nowhere, like people think of payments as kind of a done space, and we're proving that that is definitely not the case. And in fact, just thinking about some of those tailwinds for growth that I spoke about in my opening section, I think it's only going to get more disrupted over the next decade. So still a lot of our investment is going in here. Horizon 2 is where we think about products that have largely proven product market fit, but are still very nascent in terms of their scale, in terms of penetration into our install base, or maybe net new customers. So I would put products like Square Capital, Caviar, even International into this bucket, where we have a playbook, we mostly know what we want to go do, and now it's about going and executing against those Horizon 2 opportunities. Horizon 3 is the really interesting one. So great growth companies that grow over decades, in my opinion, are great in Horizon 3. Because they understand that in order to have a product or a business line that's going to be material over a 5 to 10 year period, you have to start investing today. And it's probably going to take 3 to 5 years before the first seed starts to show some early shoots. And in fact, you don't want to over business model those early seeds, because you could break the serendipity of product discovery. You could break effectively the ultimate scale that it can become. And I think one of the things we've learned a lot at Square is that innovation certainly happens in bits and bytes. It happens in the product, but it also happens in the whole experience. The price a customer pays, the way they pay, how they find a product. It is all of that combined, that cohesion of the platform, that is the secret sauce of why we've grown and grown so effectively. So great companies, Horizon 3, they get it. They're always investing with that multi-year, even multi-decade approach. The other thing they do well is they're very good at curating or editing in the space, which is a polite way to say that when something's not working or when it's not going to be a massively impactful product, they're quick to pivot away from it. And that's why we shouldn't be afraid to also say, we tried this and it didn't work and we're getting out of it. Or we tried this and it doesn't make sense. We're going to offer it for free because we think it's a great feature to drive the whole, but it doesn't make sense to monetize this piece. And so you should expect to see iteration on that front too. And I would hope you would view it as a sign of our maturity as a company, actually, that we can recognize that and that we are constantly iterating and being willing to pivot and change direction when the course looks like it's not the right course to be on. But this is how we think about longer term planning. When we go into an annual planning phase, these are the sorts of buckets that we're thinking about in terms of how we're allocating resources. Clearly, there'll still be the majority of resources going into Horizon 1, but the key is making sure that we see investments going across every phase, every life cycle. So with that brings us to long-term targets. And frankly, these haven't changed since we stood in front of you at the time of our IPO, except now we put some scores on the board. So we've actually shown you that we have grown adjusted revenue in FY16 at 52%. We've given you guidance on 2017 at the midpoint of 31%. We just gave that 2 weeks ago. But we're doing it prudently. We do want to make sure that as we grow, we're showing you that we can do it by improving our margins. And so we have targeted about a mid-single digit margin improvement annually from here. We think that's the right balance of growth with margin improvement. Longer term, what do we think we can do? We think we can remain a really high growth company. We think we can do it with a margin profile, though, that is really best in class. And that's why, to take you back, why we wanted to show you that incremental margin piece, so you can understand why we believe that's doable, but it's certainly not yet the right place for us to be on the spectrum because we have so much growth and opportunity ahead of us. So I'm going to wrap it up, and then I'll invite Jesse and Kevin to join me on stage for some Q&A. But our business model, we love it. We think it's a machine. Every time I have to stand in front of you and talk about it, I get more excited about it, actually. So we have scale. We have growth at scale. We have incredibly attractive cohort economics, and we have a really strong margin trajectory. And this is what we think is going to create an amazing investment opportunity.